Question 1. Which of the following is a mandatory benefit feature that must be included in Oregon long-term care insurance policies? A. Guaranteed renewability. B. Inflation protection. C. Non-forfeiture benefits. D. Daily benefit amount. Answer A. Guaranteed renewability. Explanation. Under Oregon law, long-term care insurance policies are required to include the feature of guaranteed renewability. This ensures that policyholders can renew their policies as long as they pay the premiums, regardless of their health status at the time of renewal, while inflation protection, option B, is a valuable feature. It is not mandatory. It is an optional benefit that policyholders may choose to include. Non-forfeiture benefits, option C, also apply to certain policies, but are not a requirement across the board. The daily benefit amount, option D, is a feature that determines how much will be paid per day for covered services, but is not mandated by law. Question 2. Mr. Thompson is 75 years old and has just been diagnosed with a chronic illness requiring long-term care. He has a long-term care insurance policy that includes a 90-day elimination period. If Mr. Thompson starts receiving care immediately, how long must he wait before his insurance begins to pay benefits? A. 30 days. B. 60 days. C. 90 days. D. 120 days. Answer. C. 90 days. Explanation. The elimination period in a long-term care insurance policy is the duration that the insured must wait before benefits begin to be paid. In this scenario, Mr. Thompson's policy has a 90-day elimination period, which means he will need to pay out of pocket for the first 90 days of care. After that period, his insurance will start covering the costs associated with his long-term care. It is critical for policyholders to understand this provision, as it can significantly impact their financial planning when they require care. Question 3. Scenario. Mrs. Roberts has been considering long-term care insurance but is unsure if she qualifies based on her current health. She is 68 years old and has a history of hypertension, which is well managed with medication. After consulting with her insurance agent, she is told she will undergo a health assessment to determine eligibility. Which of the following factors will most likely influence the underwriting decision for Mrs. Roberts' policy? A. Her age and the stability of her hypertension. B. The total amount of assets she has. C. The opinion of her primary care physician. D. The specific care needs she anticipates in the future. Answer A. Her age and the stability of her hypertension. Explanation. Underwriting decisions for long-term care insurance are primarily based on the applicant's age and health conditions. In Mrs. Roberts' case, her age, 68 years, will be a significant factor, as older individuals may face higher premiums or stricter underwriting criteria. Additionally, the stability of her hypertension is crucial, since it is managed with medication. This may positively influence her eligibility, while the total amount of assets, option B, can affect financial underwriting. It is not the primary concern in assessing health risk. The opinion of her physician, option C, may provide insights but is not a deciding factor on its own. Anticipated future care needs, option D, are also relevant but not as critical as the current health assessment and age in the initial underwriting process. Question 4. Which of the following statements accurately describes a key characteristic of hybrid long-term care insurance policies? A. They provide only a death benefit if not used for long-term care. B. They combine long-term care benefits with a life insurance policy. C. They are more expensive than traditional long-term care policies. D. They do not require underwriting to qualify. Answer. B. They combine long-term care benefits with a life insurance policy. Explanation. Hybrid long-term care insurance policies combine features of long-term care insurance with life insurance. This means that if the insured does not use the long-term care benefits, their beneficiaries will receive a death benefit. This structure appeals to consumers who wish to ensure their premiums will not be lost if they do not require long-term care. While hybrid policies can sometimes be more expensive, option C, the cost depends on various factors, including the specifics of the policy. Additionally, hybrid policies typically require underwriting, so option D is incorrect. Finally, option is misleading because while a hybrid policy may pay a death benefit, it does not solely provide that benefit. Question 5. What is the primary purpose of the non-forfeiture benefit in a long-term care insurance policy? A. To ensure premium payments are returned if the policyholder cancels. B. To provide a partial refund of premiums after a claim is made. C. To guarantee some level of benefits if the policy lapses after a certain period. D. To increase the daily benefit amount over time. Answer. C. To guarantee some level of benefits if the policy lapses after a certain period. Explanation. The non-forfeiture benefit ensures that policyholders do not completely lose their benefits if they stop paying premiums after a certain period of time. For example, if a policyholder has been paying premiums for several years and then stops, the non-forfeiture benefit may allow them to receive a reduced benefit amount based on their contributions. Option A is incorrect as non-forfeiture does not involve returning premium payments. Option B is also incorrect as it does not pertain to refunds of premiums after claims. Lastly, option D is incorrect since the non-forfeiture benefit does not inherently increase the daily benefit amount. Question 6. MS. Garcia is considering a long-term care insurance policy with an elimination period of 180 days. If she incurs long-term care costs of $200 per day, what is the total amount she would need to pay out of pocket before her insurance benefits kick in? A. $6,000. B. $36,000. C. $54,000. D. $72,000. Answer. C. $54,000. Explanation. To calculate the total amount MS Garcia would need to pay out of pocket, we can use the formula total out of pocket equals daily cost x elimination period, substituting in the given values. Total out of pocket equals $200 day x 180 d equals $36,000. This calculation shows that MS Garcia must cover the costs for the entire elimination period before her insurance starts paying benefits. Hence, the total is $36,000, option B, making this the correct answer. Question 7. In Oregon, which of the following consumer protections is mandated for long-term care insurance policyholders? A. The right to a full refund of premiums if the policy is cancelled within 30 days. B. A guaranteed acceptance for individuals over the age of 70. C. A requirement that policies must include coverage for all types of care settings. D. The ability to convert a traditional policy into a hybrid policy at any time. Answer A. The right to a full refund of premiums if the policy is cancelled within 30 days. Explanation. Oregon law requires that long-term care insurance policies offer a free look period during which policyholders can review the policy and cancel it for a full refund of premiums if they do so within 30 days. This consumer protection allows individuals to reconsider their purchase without financial loss. Option B is incorrect because guaranteed acceptance is not a requirement in Oregon. Option C is misleading as not all policies must cover every type of care setting. Finally, option D is incorrect because policy conversion options are not mandated by law. Question 8. Which of the following best describes the role of the Oregon Department of Human Services in relation to long-term care insurance? A. It underwrites long-term care insurance policies. B. It provides funding for all long-term care services in Oregon. C. It regulates long-term care insurance providers and ensures consumer protections. D. It manages the claims process for long-term care insurance policies. Answer. C. It regulates long-term care insurance providers and ensures consumer protections. Explanation. The Oregon Department of Human Services oversees the regulation of long-term care insurance providers, ensuring compliance with state laws and protecting consumer rights. This includes monitoring insurance policies, handling consumer complaints, and enforcing regulations that safeguard policyholders. Option is incorrect as underwriting is typically the responsibility of insurance companies. Option B is misleading. While the Department of Human Services may provide support and information, it does not directly fund all long-term care services. Option D is also incorrect as the claims process is usually managed by the insurance companies themselves. Question 9. What is the primary advantage of including inflation protection in a long-term care insurance policy? A. Increases the total premium amount over the life of the policy. B. It ensures that benefits keep pace with the rising costs of care. C. It guarantees that coverage is available for the insured's lifetime. D. It reduces the elimination period for claims. Answer. B. It ensures that benefits keep pace with the rising costs of care. Explanation. Inflation protection is a critical feature in long-term care insurance policies that helps ensure that the daily or monthly benefit amounts will increase over time, keeping pace with the rising costs of long-term care services. As healthcare costs rise, this feature helps prevent the benefit amount from becoming insufficient to cover necessary care. While including inflation protection can lead to higher premiums, option A, this is a trade-off for maintaining adequate coverage. Options C and D are incorrect, as inflation protection does not guarantee lifetime coverage or reduce the elimination period. Question 10. Mr. White is reviewing his long-term care insurance policy and notices a provision regarding pre-existing conditions. But which of the following statements best describes how pre-existing conditions affect his coverage? A. They are never covered regardless of the waiting period. B. Coverage for pre-existing conditions is typically excluded for a certain period. C. Pre-existing conditions are covered after a 12-month waiting period. D. All pre-existing conditions must be disclosed but are covered immediately. Answer: B. Coverage for pre-existing conditions is typically excluded for a certain period. Explanation: long-term care insurance policies commonly contain exclusions for pre-existing conditions for a specific time frame, often referred to as the look-back period. This means that if Mr. White had a condition diagnosed or treated before purchasing the policy, benefits related to that condition would typically be excluded for a certain period, often 6 to 12 months. Option A is incorrect, as not all conditions are excluded indefinitely. Option C is misleading, as coverage for pre-existing conditions is not guaranteed after a 12-month waiting period without specific policy provisions. Option D is incorrect because, while disclosure is essential, coverage for pre-existing conditions is not typically immediate. Question 11. Which of the following statements regarding the Oregon Long-Term Care Insurance Act is true? A. It mandates that all long-term care insurance policies must provide coverage for Alzheimer's disease. B. It establishes minimum standards for long-term care insurance policy benefits and protections. C. It requires insurers to offer a choice of benefits with no age restrictions. D. It prohibits insurers from using age as a factor in determining premiums. Answer: B. It establishes minimum standards for long-term care insurance policy benefits and protections. Explanation: the Oregon Long-Term Care Insurance Act provides a framework that includes minimum standards for the benefits and protections afforded to consumers. This legislation aims to ensure that policyholders receive adequate coverage and are protected from unfair practices. Option A is incorrect because, while Alzheimer's coverage is critical, it is not mandated for all policies. Option C is misleading, as there may be age restrictions on certain benefit options. Finally, option D is false because age is a commonly accepted factor in determining premiums. Question 12. Mr. Lee has a long-term care insurance policy with a daily benefit amount of $150. If he incurs care cost of $200 per day, how much will he be responsible for paying out of pocket per day? A. $50. B. $150. C. $200. D. $350. Answer: A. $50. Explanation: to calculate Mr. Lee's out-of-pocket expense, we subtract his daily benefit amount from his actual daily care cost. Out-of-pocket equals daily care cost. Daily benefit amount, substituting in the values. Out-of-pocket equals 200. 100 for equals 50. Thus, Mr. Lee will need to pay $50 out of pocket each day. Options B, C, and D are incorrect as they do not reflect the correct calculation. Question 13. Which of the following is a primary reason consumers should consider long-term care insurance as part of their financial planning? A. It provides guaranteed benefits that cannot change over time. B. It can help protect assets from being depleted by long-term care costs. C. It is a legal requirement for individuals over the age of 65 in Oregon. D. It offers tax credits for premiums paid. Answer: B. It can help protect assets from being depleted by long-term care costs. Explanation: one of the main advantages of long-term care insurance is that it helps protect individual savings and assets from being exhausted by the high costs associated with long-term care services. This protection is vital for maintaining financial stability and legacy planning. Option is misleading, and while some policies have guaranteed benefits, others may have adjustable features. Option C is incorrect, as long-term care insurance is not a legal requirement. Finally, while some tax deductions may apply, tax credits for premiums paid, option D, are not typically available. Question 14. Under what circumstances might a long-term care insurance policy be considered for cancellation on non-renewal? A. If the insured is hospitalized for more than 30 days. B. If the insurer has not received premium payments for 2 consecutive months. C. If the insured is diagnosed with a new health condition. D. If the policyholder turns 75 years old. Answer: B. If the insurer has not received premium payments for 2 consecutive months. Explanation: insurers can cancel or refuse to renew a long-term care insurance policy if premiums are not paid within a specified period. This is common practice and is stipulated in most insurance contracts. Option A is incorrect because hospitalization does not trigger cancellation. Option C is misleading. A diagnosis alone does not lead to cancellation without non-payment. Finally, turning 75, option D, does not automatically result in cancellation or non-renewal. Question 15. Which of the following is not typically included as a benefit under long-term care insurance policies? A. Assistance with daily living activities. B. Respite care for family caregivers. C. Coverage for experimental medical treatments. D. Care in a skilled nursing facility. Answer: C. Coverage for experimental medical treatments. Explanation: long-term care insurance policies generally focus on providing coverage for assistance with daily living activities, respite care for family caregivers, and care in skilled nursing facilities. However, coverage for experimental medical treatments, option C, is not typically included as these treatments are outside the scope of standard long-term care services. Thus, this option correctly identifies what is generally excluded from coverage. Question 16. In Oregon, which of the following factors is most relevant for determining a policyholder's premium rates for long-term care insurance? A. The policyholder's family history of illness. B. The total amount of savings the policyholder has. C. The policyholder's current health status and age. D. The policyholder's previous insurance claims history. Answer: C. The policyholder's current health status and age. Explanation: when determining premium rates for long-term care insurance, insurers primarily consider the applicant's current health status and age, as these factors directly impact the likelihood of requiring long-term care services in the future. Option is less relevant as family history may provide context but is not a deciding factor. Option B does not directly influence premiums, while previous claims history, option D, can have some influence. It is less significant than current health and age. Question 17. What is the purpose of the free look provision in long-term care insurance policies? A. To allow policyholders to renew their policy without additional costs. B. To give policyholders a specified period to review and cancel the policy for a full refund. C. To ensure that policyholders can change their coverage level without penalty. D. To provide a grace period for late premium payments. Answer: B. To give policyholders a specified period to review and cancel the policy for a full refund. Explanation: the free look provision is a consumer protection feature that allows policyholders to examine their long-term care insurance policy for a set period, typically 30 days, and cancel it if they choose, receiving a full refund of premiums paid. This provision helps ensure that consumers have the opportunity to fully understand the terms of their policy without the risk of financial loss. Options A, C, and D are incorrect as they do not accurately describe the function of the free look provision. Question 18. Which of the following is a common exclusion found in long-term care insurance policies? A. Care received from family members. B. Care provided in a skilled nursing facility. C. Custodial care. D. Care for chronic conditions. Answer A. Care received from family members. Explanation: many long-term care insurance policies typically exclude coverage for care provided by family members. This exclusion is intended to limit the insurer's liability and manage costs. Options B and C are incorrect, as care provided in skilled nursing facilities and custodial care generally covered by most long-term care policies. Option D is also incorrect. Chronic conditions may be covered depending on the specific policy terms. Question 19. In the context of long-term care insurance, what does the term benefit period refer to? A. The duration for which premiums are paid. B. The length of time benefits will be paid for care received. C. The waiting period before benefits begin. D. The maximum age at which benefits can be received. Answer: B. The length of time benefits will be paid for care received. Explanation: the benefit period in a long-term care insurance policy defines the maximum duration for which the insurer will pay benefits once the insured begins to receive long-term care. This period can vary significantly between policies, and understanding it is crucial for policyholders to plan for their potential care needs. Options A and C refer to other terms in the insurance context, and option D incorrectly defines an age limit, which is not what the benefit period entails. Question 20. Mr. Davis is reviewing his long-term care insurance policy and notices a clause regarding exclusions. Which of the following scenarios would likely be considered an exclusion under his policy? A. Mr. Davis requires assistance with activities of daily living after a stroke. B. Mr. Davis is diagnosed with a mental health disorder that requires treatment. C. Mr. Davis is receiving care in a state-funded assisted living facility. D. Mr. Davis has a pre-existing condition that was diagnosed before his policy was issued. Answer: D. Mr. Davis has a pre-existing condition that was diagnosed before his policy was issued. Explanation: pre-existing conditions are commonly excluded from coverage in long-term care insurance policies, especially if they were diagnosed or treated before the policy's effective date. This means that Mr. Davis would likely not receive benefits related to that condition. Option A would typically be covered since it pertains to long-term care needs. Option B may or may not be excluded depending on the specifics of the policy and the nature of the mental health disorder. Option C is incorrect, as care in a state-funded facility might still be covered depending on the policy's terms. Question 21. Which of the following accurately describes the elimination period of each long-term care insurance policy? A. The period during which the policyholder can change the policy benefits without penalty. B. The waiting period before benefits are payable after a claim is filed. C. The duration of time for which benefits will be paid once they begin. D. The time allowed for premium payments before the policy lapses. Answer: B. The waiting period before benefits are payable after a claim is filed. Explanation: the elimination period is the time frame during which the policyholder must wait before the insurance company starts paying for long-term care services after a claim is filed. This is essentially a deductible period, and it can vary from policy to policy. Option A describes a different aspect of policy management, while options C and D pertain to benefits and premium payment timelines, respectively, which do not define the elimination period. Question 22. Mr. Anderson has a long-term care insurance policy that includes inflation protection. What is the primary purpose of this feature? A. To ensure that the policy remains in force regardless of premium payment status. B. To adjust the benefits to keep pace with the rising cost of care over time. C. To allow the insured to change their coverage limits annually without penalties. D. To guarantee that the policyholder can receive care in any facility of their choice. Answer: B. To adjust the benefits to keep pace with the rising costs of care over time. Explanation: inflation protection is designed to increase the benefit amount over time to reflect the increasing costs of long-term care services. This feature is critical because it helps ensure that the policy remains adequate as the cost of care rises due to inflation. Options A, C, and D do not accurately describe the purpose of inflation protection in long-term care policies. Question 23. Which of the following is true regarding the claims process for long-term care insurance in Oregon? A. Claims must be filed within 6 months of receiving care. B. The insurer is required to make a claims decision within 30 days of receiving the claim. C. The denial of a claim cannot be appealed under any circumstances. D. Only the policyholder can file a claim, or family members cannot submit claims on their behalf. Answer: B. The insurer is required to make a claims decision within 30 days of receiving the claim. Explanation: in Oregon, once a claim is submitted, the insurer is typically required to review it and make a decision within 30 days. If the claim is denied, the policyholder has the right to appeal that decision. Option A is incorrect. There is no specific 6-month limit for filing claims in most policies. Option C is false, as there are appeal processes for denied claims. Option D is also incorrect. Authorized representatives or family members may file claims on behalf of the policyholder. Question 24. Which type of long-term care insurance policy combines traditional long-term care benefits with life insurance? A. Traditional long-term care policy. B. Hybrid policy. C. Short-term care policy. D. Standalone policy. Answer: B. Hybrid policy. Explanation: a hybrid policy combines elements of long-term care insurance with a life insurance component. This means that if the insured does not need long-term care, the policy may provide a death benefit. This structure offers more flexibility and can appeal to individuals who are concerned about the potential for unused benefits. Options A and D describe traditional coverage, while C refers to policies designed for short-term care, which do not include life insurance features. Question 25. What is the primary role of the Oregon Department of Human Services in relation to long-term care insurance? A. To provide direct insurance coverage to all residents over 65. B. To regulate the sale and marketing of long-term care insurance policies. C. To oversee the delivery of long-term care services in licensed facilities. D. To determine premium rates for long-term care insurance providers. Answer: C. To oversee the delivery of long-term care services in licensed facilities. Explanation: the Oregon Department of Human Services is responsible for overseeing the quality and delivery of long-term care services within licensed facilities. This includes ensuring that these services meet regulatory standards for care. Option is incorrect because the department does not provide insurance. Option B is partially true but does not encapsulate the primary role, which is more focused on service delivery than marketing. Option D is incorrect that the department does not set premium rates for insurance providers. Question 26. Which of the following statements about non-forfeiture benefits in long-term care insurance policies is correct? A. Non-forfeiture benefits ensure that policyholders receive a refund of premiums if they cancel their policy. B. Non-forfeiture benefits provide coverage for individuals who have paid premiums but have not received benefits. C. Non-forfeiture benefits guarantee that a portion of the benefits will be available if the policy is cancelled after a specified period. D. Non-forfeiture benefits are not available in Oregon long-term care insurance policies. Answer: C. Non-forfeiture benefits guarantee that a portion of the benefits will be available if the policy is cancelled after a specified period. Explanation: non-forfeiture benefits are designed to protect policyholders who have paid premiums for a certain period but decide to cancel their policy. These benefits typically allow them to retain a portion of the benefits or a reduced paid-up policy, which provides some level of coverage. Option A is misleading because it conflates non-forfeiture benefits with premium refunds. Option B is incorrect as it does not accurately describe the purpose of non-forfeiture benefits. Option D is false, and non-forfeiture benefits can exist within Oregon policies under specific conditions. Question 27. In Oregon, what must an insurance agent provide to a client before selling a long-term care insurance policy? A. A detailed financial analysis of the client's assets and liabilities. B. A summary of the insurance company's solvency ratings. C. A complete outline of the policy's benefits and limitations. D. A list of all available long-term care facilities in the state. Answer: C. A complete outline of the policy's benefits and limitations. Explanation: insurance agents are required to provide clients with a clear and comprehensive outline of the benefits, limitations, and exclusions of any long-term care insurance policy before the sale. This transparency is crucial for helping consumers make informed decisions. Options A, B, and D are not required disclosures under Oregon law, although they may be beneficial in certain contexts. Question 28. Which of the following is a common financial consideration when selecting a long-term care insurance policy? A. The policyholder's current employment status. B. The insurer's reputation for claims processing. C. The distance to the nearest care facility. D. The average age of the policyholder's friends. Answer: B. The insurer's reputation for claims processing. Explanation: when selecting a long-term care insurance policy, it is important to consider the insurer's reputation for claims processing. A strong track record in timely and fair claims handling is essential for ensuring that policyholders receive the benefits they expect when needed. Options A, C, and D are less relevant to the decision-making process regarding policy selection. Question 29. Mrs. Thompson has a long-term care insurance policy with a daily benefit of $250. If she has a 90-day elimination period, how much will she be required to pay out of pocket if she receives care for 100 days? A. $0. B. $2,500. C. $5,000. D. $7,500. Answer: C. $5,000. Explanation: to calculate Mrs. Thompson's out-of-pocket expenses, we first identify the total number of days she received care and then account for the elimination period. Out-of-pocket: total days elimination days x daily benefit amount. Out-of-pocket at 10090 x 200 equals and x 200 equals 2,500. The out-of-pocket amount she would pay is $2,500. So I apologize for the error in my earlier calculation. However, in the context of covering the total number of days receiving care, if the care received continued beyond the elimination period, Mrs. Thompson would have to account for the remaining care days after the elimination period. Correct calculation: her total expenses after elimination period for 10 additional days will be calculated as 10x 200 equals 2,500. So total out-of-pocket expense is $2,500, making option B the correct one. Question 30. Which of the following practices would violate Oregon's consumer protection laws regarding long-term care insurance? A. Providing accurate information about policy benefits during the sales process. B. Using high-pressure sales tactics to sell unnecessary policies. C. Allowing a consumer to review the policy in a free look period. D. Disclosing any relevant exclusions in the policy. Answer: B. Using high-pressure sales tactics to sell unnecessary policies. Explanation: high-pressure sales tactics that compel consumers to purchase unnecessary long-term care insurance policies violate Oregon's consumer protection laws. Such tactics prevent consumers from making informed decisions and can lead to financial hardship. Oregon law emphasizes the importance of ethical sales practices, ensuring that consumers receive accurate information and sufficient time to consider their options. In contrast, options A, C, and D represent compliant practices that uphold consumer rights.